Welcome to Fundamentals for Startups, a CoMotion Labs production. My name is Caroline Hansen. I'm the manager of CoMotion Labs Tech Plus incubator located here at Startup Hall. We are a multi-industry incubator hosting early-stage startups from both inside and outside the UW. We provide our members with critical infrastructure and opportunities for learning, mentoring, and networking. And we are always looking to connect with founders in life sciences, hardware, and tech. For a limited time, tech entrepreneurs can take Startup Hall for a test drive and see if our resources, advisors, and community are a good fit. Use this QR code to learn more about this program. We're running it every Friday for early stage startups. So if you're not a perfect fit for Startup Hall yet and you want to try out this test drive program, you can use that QR code. Fundamentals for Startups is a weekly lecture series on topics related to entrepreneurship. Every week we bring a new expert in to share insights and answer questions. All of these talks are streamed and saved on our YouTube channel, and you can learn about upcoming events on our website. Just a reminder, wait for the microphone before asking a question so our online audience can hear you. And I will be running the mic, so don't make me trip in an effort to get to you quickly. Today, I'm excited to introduce our 4 panelists. Investor Ken Hornstein of Opaque Ventures, Jack Nellinger of Revoluity, Sandhya, I've already forgotten. Sandhya Nikasi of Common Future, and Allison Parker of Peak Impact. They're here today to talk about impact investing. Welcome, panelists. Thank you.
Thank you, everyone, for joining us here today for impact investing at a 30,000-foot level. We're excited to be with all of you. I'm Allison Parker, founder of Peak Impact, which is an independent consultancy that works with families and foundations on their impact investing as well as their philanthropic giving. I'm excited to be hosting this panel, or I guess moderating this panel today, because we have a fantastic group. Each of them will introduce themselves, and they are all really experts in their field, not just here locally, but nationally. So we're very lucky that you're all here in town. So why don't we go down and each of you introduce yourselves briefly.
Hey, everyone. And thank you, Allison, for inviting us to this panel. And thank you, everyone here. I know it's a very cold day, so really appreciate you coming out in the cold. My name is Sandhya Nikasi. I use she, her pronouns, and I am a co-CEO at Common Future. My background is in finance, impact investing, risk management. I have over 15 years of experience in those fields. And yeah, I think relevant to this conversation today, I started my own impact first investing fund with a colleague about 5 years ago, and that is still running. And yeah, I'm just really excited to be here today and happy to answer any questions you all have, and I'll pass it to you, Jack.
Sounds good. Thank you for having me, and I'm excited to participate on the panel today with all of you. My name is Jack Nellinger. My background, I'm actually a software engineer by training, but quickly realized that wasn't the path for me. So ironically, I moved to Seattle to not do software development. I actually did a stint with AmeriCorps, the AmeriCorps Vista program, which was the domestic version of Peace Corps. So that introduced me to social entrepreneurship through my work with Ashoka. And from there, I had a bit of a winding journey to reach the impact investment scene. So I got involved with corporate CSR, venture philanthropy, and eventually incubators and accelerators. And along that journey, it led me to my previous firm, Capria, where I was a co-founder and a partner there, which is where I spent the better part of the past decade. And for the past 2 years or so, I've been on my own advising early stage entrepreneurs and emerging fund managers.
Awesome. Hey, y'all. I'm Ken Hornstein. I'm the founder and general partner of Opaque Ventures. We're a preferred venture partner for the University of Washington, and my office is a couple buildings over, so I'm here pretty often. We're a pre-seed and seed stage venture fund. We're actually primarily financially return focused, But I've spent about a decade now in venture, including time with Microsoft's venture fund, which is called M12, and also as a kind of lead advisor at Social Venture Partners, which is a firm actually started here, but is now, I know, at least across the U.S., maybe even global at this, global at this point, which really focuses on new nonprofit companies, new programs within existing nonprofit companies, and then public benefit or B corporation type of ideas. And so spent a number of years there working with founders, working at the kind of intersection of innovation and impact.
Wonderful, thank you. To get us started, I want to do a little bit of framing of what impact investing is. So impact investing is intentionally making investments that have either a social or environmental benefit alongside a financial return. So the intentionality is really important when we think of impact investing. And to give you kind of a broad sweep as to the market size and what we're looking at, the GIN, which is the Global Impact Investing Network, does an annual survey. And so the most recent one from 2024 showed that there were nearly 4,000 organizations worldwide managing over 1.5 trillion US dollars in impact investment AUM. And that's huge. It is primarily concentrated in North America with about 35% and Europe at about 53%. And so that kind of gives you the sense of the scope. Who are the players in impact investing? Well, it can be anything from, foundations and endowments, which is my background, to individuals, family offices, venture capitalists. Some companies do impact investing. There are sovereign wealth funds as well, and some pension and insurance companies are also dipping their toe into impact investing. And in terms of kind of the fields or the themes that have seen a lot of impact investments, we're really looking at a lot of climate change, regenerative ag. I see you nodding your heads, healthcare innovation, and financial inclusion. So that just kind of gives you a nice kind of broad overview of the world of impact investing. So now I'm going to turn to our panel to get into some of the interesting things that we thought would be most applicable to startups. So I'll start with you, Sonia. So as someone who's deeply embedded in impact investing, both regionally and nationally, could you share your perspective on how the landscape has evolved, particularly around innovative financing structures?
Yeah, thank you, Allison. Excuse me. So I guess to start off, Allison shared the market is 1.5 trillion. Over the last 10, 15 years, I would say the availability of impact investing products has really kind of accelerated and matched more of the traditional space as well. So you will see a lot of products that we would see more in traditional spaces being available in the impact investing world. Equity investments. I know that Gates locally was one of the first to actually start publicizing and then talking more about program-related investments, and that was actually an equity investment that they made in a company in, I believe, in Africa, I think was the first one. So I think, over the last 15 years, it's the impact investing world is like completely become increasingly sophisticated in the products that they offer. I would also say that, specifically for startups, there are two products that I would say that stand out as emerging and relevant, especially because of their non-dilutive or potential for non-dilutive financing support for startups. So the first one is recoverable grants or forgivable loans is another alternative way that this has been framed. And then the second product is revenue-based financing. So there are revenue-based financing structures that are more equity-like and can lead to dilution, but there are a lot of options that are available now that are structured a little bit more like debt. So both of these I would say are more emerging in the space. And I wouldn't say that these are like innovative or new. These products have existed for quite some time, but I think that they're really relevant for founders who are looking for non-dilutive financing options. On the recoverable grant side, this actually has become a little bit more of a focus on the foundation and family office side more recently within the past 5 years, specifically because recoverable grants can be structured as an actual grant and it doesn't have to come out of their program-related investment portfolio, which foundations and philanthropy likes to have two hats of thinking. But also I would say they can be quite cumbersome in terms of kind of when you're starting to work with an investor around a recoverable grant, because these structures are not widely known. You'll get into trip-ups around documentation or how do you want to structure this. There's no one way to structure a recoverable grant. And so I think that the things that I would be kind of mindful of when if you're thinking about a recoverable grant is, what is the expectation and the trigger for repayment, and how does that actually support you and your growth? And I will just quickly pivot to the revenue-based financing side, and just share. I have a background in providing revenue-based financing that has been more debt-like, but I think the things there to be just mindful of are they can be quite extractive. So thinking about the return cap and trying to understand and do your own modeling about how quickly you'll be able to repay this loan and how much interest, quote unquote, you will be paying back. They can be structured quite extractively and really take more money out of your organization that could hinder growth in the future. And they are kind of more regular payments. It's just harder to predict because it aligns with your revenue. But I think there are obvious positives for both of these structures. A recoverable grant, if you don't hit those targets, you don't have to pay back that money. And so that is it's really helpful for startups who are starting to iterate and you haven't really quite landed on that model and you need a little bit of flexibility to test out. And then on the revenue-based financing side, something that I would add as a really great bonus is obviously because it is in line with your revenue. So 0% revenue. If you don't make any revenue, you don't have to pay anything back. But obviously, the devil is in the details with all of these things, and I think it's really important to. And I think we'll talk about this later in terms of risks and trade-offs around impact investing specifically. Is I think that's just really trying to understand what are these agreements, what's being said in these agreements, and making sure that that's really aligned with your organization's mission, your purpose, the impact that you're trying to reach, and that the investor is aligned with those as well. I think that answers your question, but if there's anything that follows up, please.
Thank you. Yeah, and just so you all know, we will have time for Q&A. We're leaving a lot of time for that because we hope you will all have questions for us. I'm actually going to skip down to Ken, but I will get back to you, Jack. So now that we understand the landscape and some of the challenges, emerging opportunities, I'd love for you to talk a little bit more about some of those trade-offs and kind of, risks and opportunities, so to speak. In particular, I think the audience would be interested in hearing about any hidden costs.
Yeah, I think this is a great question because we have a ton of founders who get grants, maybe they get loans, or they get something that feels on its surface like it's not dilutive. Almost feels like it's a free lunch, right? You find a grant that's really aligned with whatever the research you're doing or your product does, and someone says, hey, we're willing to just give you this money to progress it towards some particular end. But I think it's always important to realize that there is no free money. So you are consciously making a decision of how much time you are going to focus on the things affiliated with that grant or that loan. And oftentimes founders can get tripped up where they don't actually do the hard work of saying, I understand how this facilitates the underlying platform or the rest of the product that I'm building. And so, yes, I might get $1 million grant here, but if you have to spend 70% of your time fulfilling those requirements, but only 10% of it is actually beneficial to your company, that's not a good trade-off, right? And so I think founders often get caught up in just seeing the numbers and seeing the fact that it's not going to take equity. Again, like the devil's in the details. I was recently talking with a friend who's funded dozens of companies, hundreds of millions of dollars, both dilutive and non-dilutive. And she brought up this point that a lot of these institutions or organizations that provide these grants, there will be things in that grant that could have a drastic impact on the future of your company. And she brought up the example of a founder having signed something thinking, oh, this is a nonprofit that really wants this particular cure to be in the world, didn't really do their full due diligence, and later realized, oh, we assigned all of the intellectual property we created with this grant to this institution. And it wasn't like that was called out in a super specific way. They don't raise huge flags and say, just so you know, this is what we're getting, right? And so the simple answer here is always have a good attorney that looks at these things. But the grant process isn't just about, I'm going to get this money and how am I going to use it post-money. Our founders who do this the best, they have teams of people working on these grants. So there is a opportunity cost, that upfront cost. And so for your business or for whatever area you're focused on, how can you quickly understand what the trade-offs are, how much time is going to be required before you go down what could be a multi-month or maybe multi-year rabbit hole that is going to distract you and your limited time away from the bigger vision you're trying to accomplish.
So Jack, moving over to you now. So let's build off these considerations and trade-offs, and would love to hear from you a little bit more from the equity side of things. Kind of what's the difference between impact investing and traditional normative funding? And in particular, are there any tips that you want to share regarding reporting or expectations with impact investors?
Sure. So I think picking up on Ken's point there with the IP situation or the different structures that Sandia hit on, there's a full spectrum of impact investors out there, and so the obligations, the requirements that they're placing on you is going to tell you a lot about how they perceive impact. So even prior to getting to the actual terms, investment documentation, side letters, whatever it happens to be, their diligence process is also going to tell you about what they care about. So that's one thing that I'd point out. And it really is a two-way street. Definitely recommend to all founders as well as fund managers, get to know your investors in the same way that they're doing their diligence on you. Go talk to other founders, figure out who are, if you're working with a fund or approaching a fund, who are the fund's investors? Because the obligations that you take on as a fund manager from your investors are then passed on to you as a company. So from a reporting standpoint, there's some of the standards around IRIS metrics that are often used, alignment to SDGs. You'll see a lot of that. In terms of the granularity, the frequency, that's going to vary. So some are going to want it quarterly, some are going to want it semi-annually, some will only want it annually. And when you look at the quote-unquote traditional investment landscape, sometimes you won't see any of that, right? You won't see any sort of requests for information on what you have in place from an ESG standpoint or how you're actually going to measure the impact that you set out to do. And when you're going through those negotiations, I think it is important to keep in mind, is this realistic for me as a firm and where I'm at to be able to actually deliver on this? If you're a 3-person startup, and all of a sudden your obligations just extend so far that your team's not actually able to make sure that the business can actually move forward and thrive, that's not going to benefit anyone, and it's not going to benefit your impact. So I think there's all those considerations to take into account, and there's a wide spectrum of things we could get into around what that looks like or how to approach it.
Thanks. So given everything we've talked about regarding, opportunities, risks, requirements, I'd love to hear from each of you. In your opinion, who do you think is an ideal candidate for impact investing? And you can go in any order you'd like.
Yeah, sure, I can start. Yeah, this is a good question. I mean, I feel like maybe just to set $1.5 trillion, that's like JP Morgan. That's like all of JP Morgan's assets. So let's be realistic about how big the impact investing ecosystem actually is. So if you're going after these dollars, also recognize this has to be aligned. This isn't just another way you can get money. I think if you're going after these dollars, you really have to be, thinking about, as Jack said, you're gonna have to do a lot of reporting. So make sure that whatever you're doing is actually impactful. You are, I would just try to kind of think about what is the business that you're trying to build, and what is the right type of financing for me at this point in time. Is it that oh great, I have this for-profit business that also I didn't realize that it would have this really great benefit for the community, but okay, cool, it does, and so maybe I'll go after impact investing dollars. Maybe that's a good use of your time, or maybe it's not. I think you have to kind of survey the landscape of potential investors that you have available to you, and really understand is that even a priority? Because it might not even be a priority for the impact investors specifically that you're connected with. That might not be the issue area or the thing that they want to advance. So I think it's listen, and also I would love for all investing to be impact investing. I'm out here trying to actually, I'm a person who wants to see the financial system change. I'm not here trying to say, don't go after impact investing. But impact investing has become such a widely diluted space where it goes anything from a do not harm screen to a deeply impactful private investment. So that 1.5 trillion is all the way from ESG funds to private investments. So it's just also when you're thinking about this space and entering this space, I would just be realistic about what is your organization or company doing, and is it actually aligned to go after these impact dollars, knowing that what you're looking for is probably more of a private investment, which is a smaller part of that market, and what you'll be able to reach. So I'm not trying to discourage you. I love impact investing. I would love it for it to continue propagating, but I'm also just very realistic about the space. And as somebody who's had to raise impact dollars myself, it is very hard. It's hard. And I've spent a lot of time, and I am still spending a lot of time raising these dollars. So I'm just trying to be very realistic.
I actually think following up on your point there around thinking about the broader landscape is something to definitely be mindful of, is how are other investors going to perceive the terms of any agreement you enter into, regardless of if it's an impact investor or a traditional investor. Because oftentimes there will be competing viewpoints on what that means for the business, whether that's what it means for the business in its ability to deliver the impact that it intends to, or whether it's the ability for the business to actually produce the financial returns that certain investors want. So I think keeping that in mind early is definitely something that I would highly recommend. In terms of the ideal candidate, I mean, from my standpoint, I'm the same. I would like to see all investing be impact investing, just as I would like to see all companies have some ethos and intention to solve problems and not just look at a bottom line. So from the ideal candidate standpoint, I'd say, do you care about things beyond your bottom line? If so, you're a candidate. Let's open up the conversation because it's a complex topic.
Yeah, I think both these answers are great. So there's two things I would say, and the first part is kind of restating what you guys just said, which was great. So I think there's kind of 3 A's for me in impact events investing. There's alignment, So is this company actually doing something that I, as an impact investor, care about? Ability. Can they actually execute on it? Can they do the thing that they are saying they are going to do? And then importantly is accountability. Are you at the stage where you could track that, measure that, and report out and say, we actually did what we said we were going to do? And sometimes at the earliest stages, like a brand new pre-seed life science company, you do have that like right from the beginning because you have such a narrow focus. You're going after such a specific disease state. It's very clear what the scientific metrics are to prove that you are on the right path. But you know, if you're building some type of software business or something where it's like, well, we've got to get to a certain market size, or it's really not going to be able to show that we have the ability or the accountability for 5, 6, 7 years, it can be tough. And that might push, you know, your ability to go get this type of investment much later. So it kind of brings me to my second point, which is actually more than just impact investors. As a founder, you are selling a product. You're selling part of your company to someone like us, right? Of course, you're also selling whatever your product is, but through the fundraising process, your whole goal is to work like a marketer. Who is the right investor to purchase this product? And it's not the whole world of impact investors. It's not the 1.5 trillion. And oftentimes I see founders just go in circles thinking, you have investor in your title on LinkedIn, I want to talk to you. And that actually is kind of wasted time, right? So there's thousands, tens of thousands of us out there. How do you get down to probably the 200 that fit those 3 A's for you? And then focus your energy on talking to those people, right? As opposed to just saying, I'm going to go talk to the world and figure out if they like this thing that I've built. You really have to approach this fundraise as a marketer, in my opinion.
Great, those are all good points. So we want to pause in our talking at you and give you all a chance to ask questions. So there is a floating microphone, and please use that. Okay.
Hey, thanks. I was curious to know if there are impact areas where there's like a lot of demand from investors, but they struggle to actually find organizations, if any, come to mind.
I don't know about struggle to find. Yeah, I think there's a lot of, I mean, Allison shared at the beginning the top 3 areas, which I think are very much spot on: financial inclusion, climate, and what was the third that you mentioned? Regenerative ag. Yes, regenerative ag, which, you know, fits within climate. I mean, I think I would just also maybe like forget about what was, and like we're in like uncharted territory in this moment in time, and there's a lot of funding that's being taken away at the government level for a lot of organizations that do impactful work. I think a big one is a lot of lost funding for climate, with the GGRF dollars being pulled back. Greenhouse gas reduction fund dollars being pulled back. But I also don't think like there's any shortage of organizations that are out there kind of tackling these issues. But yeah, I mean, I think to being ahead of that curve and kind of seeing into the, I think looking into the future of what might be next around the corner in terms of things that will be investable. I mean, I don't know. I'm not a soothsayer, but I think a lot of, I think like there's going to be a lot of attention on immigration, and I think there are a lot of apps and organizations and all of this stuff that are focused on immigration, but I think there's, safety and it's going to be a big deal.
Yeah, so I would say most of the problems are probably known at this point, right? And they fit into most of these categories. You might add things like preservation of democracy or free speech or some of those in the recent weeks. I think that, and you guys can disagree with me, but I think the question is, are these the people who can actually do this? So at our stage, it's 90% the people. And it's 8%, 9%, what's the size of the opportunity? Is it sustainable? Like all of those things. And then it's 1% the idea. Because the only thing I can guarantee you is the idea that you come and pitch to me, on day one, if we invest, and when we invest, we're usually expecting to spend the next 10 years of our life with you. The only thing I can guarantee you is it will not be the same thing at the end of those 10 years. So to me, it's less about like, hey, we're looking for an idea in this space. Y Combinator is very famous for they have this request for startups list, which is actually a great place to start. If you don't even have your idea yet and you're like, I know I want to be an entrepreneur, I want to have impact, that's a good list to start with, in my opinion. But the other thing that I think we're trying to figure out, and this is where impact investing and more traditional venture like our fund does, this blending of we are going to have a massive impact, and at the same time, we're going to build a massive business. And the reason that's important to me is so far, from what we've had for all of the history of mankind, for all of its faults, capitalism still seems to be the best system that we've ever been able to come up with. And so if you can create a way, like we just did a clean tech deal, where if they're successful, it is going to have a revolutionary impact on greenhouse gas emissions. They will also build a probably $50 billion company because they will get rewarded for that, because I think as society, we have started to blend those two things in a more healthy way. And so their first investment was from a financially focused VC. I think it's going to take a couple $100 million to have their impact. And I think 90% of that will be non-dilutive or impact-focused funds. But that used to kind of flip. When I started in this industry, you would see all of the non-dilutive, all of these things have to come first, and then maybe that convinced a financial VC to join. But I'm seeing more and more of the opposite example starting to happen.
Question, they would love your perspective on startups coming out as a B Corp versus a C Corp with a nonprofit foundation. What are sort of, from the investor's side, the pros and cons of B Corps?
I will repeat the questions. I don't know if our friends online heard it. Oh, you are? Okay, great. All right. Go ahead then.
I'll jump in first on that one. I have strong views on this. The way you choose to structure your company, there's plenty of ways to be creative. I think the more complexity you add in the early days, the more questions you're going to have as people engage in their due diligence process. So I'm not advocating for one or the other, but it's what's the intent of the structure, what purpose is it serving, and is it fundamentally needed to accomplish what you want. And so I had a company that was one of the first 50 social purpose companies in Washington State, because Washington State decided to adopt a social purpose corporation instead of the traditional B Corp. And quite frankly, I don't really think it did anything for us. Now, did it have us looking inwardly and saying, like, this is our standard and this is the direction we want to go? Yes. And there are certain protections you get for later in your journey, depending on how you decide to structure or what you decide to paper in terms of your company formation. But I think that I think you really just need to think about the why behind it and understand the ramifications around it. But just as an example, to throw one out that's fairly recent, the last 3 days, Dr. Bronner's basically backed out of the B certification. Mm-hmm. They said, we don't believe the standard's high enough anymore. And as far as the certification goes, that one's pretty high up there. So for a company to come out and say they're pulling out because they think it's impact washing, that's a whole conversation by itself in terms of just how in depth we could go on some of these topics, including formation.
Hi, I'm curious. How do you assess successful impact? Like, is it inherently subjective? Do you have quantitative measures? Curious on your thoughts.
I think we would all have different answers. I maybe come from more of a place where I'm trying to set, if my organization is focused on impact, impacting who, impacting what, and making sure that the people who are impacted or the thing that is being impacted has autonomy in deciding what success looks like for them. So for me, I can't be successful if the thing or the product or the whatever I'm creating is not actually, it's not deemed successful for the end user or the end client. So I think, I mean, that's not maybe like the most investor-y way to say this or the most investor-y aligned perspective. But it is, if we're talking about actually having true impact within the sphere, whatever sphere you're in, I would continue to think about if I'm designing an app for a person, like what is that person who's going to be using that app? How will they deem this thing successful?
Yeah, I think that's right. In terms of my experience working primarily with foundations, they're really looking at not only your company, but who are those end users and really making an impact there. And oftentimes they'll have like a matrix or a scorecard that is entirely focused on impact and have that alongside more of a traditional financial due diligence scorecard. And those both have to rank at a certain level in order to make the investment.
We have another question from online. Do you have any recommended resources that sort of outline, maybe the landscape of who the impact investors are and their focus? Is there, if someone's interested in taking that marketing approach that Ken talked about, the best place to sort of identify the potential customers?
I don't know that I know them on the impact side. Well, this is where the blending of regular financial VCs and impact investors is starting to happen so much. But so a couple tools that I like that you could definitely find investors. One is called NFX Signal, and you can go online and they've pretty much created a database of every venture, early stage kind of startup type investor, and you can filter by clean tech, biotech, literally thousands of different things. And so you could find who are the people who are focused on my category, right? Agricultural, all of it. And right there, you've just cut the world down from tens of thousands of potential people to hundreds. And that can be a good place to start. I don't know if there's other good, whether it's industry resources that provide this kind of stuff.
Well, I mean, I think there's some general associations. So the GIN is an example, right? Global Impact Investment Network. You can look at all of the members in that network. Do your own diligence on them. There's going to be quite a bit of variation with who's there. There's Impact Assets. They highlight different organizations that are in the impact investment sphere. You could look at things like the operating principles for impact management, which was something I believe the IFC promoted and backed, the International Finance Corporation. So I would say there's industry bodies, and then some of those bodies I think reflect either a broader swath of the ecosystem, and some may lean more towards finance first, some may lean more towards impact first.
Yeah. On the philanthropy side, Mission Investors Exchange, you could look at their membership list for foundations, and then Intentional Endowments Network. Their membership list would be endowments, but also with a lot of religious organizations. So there's a lot of large foundations tied to many different types of religions, and those would be two membership lists to check out. I did see that somebody had their hand raised in the middle. Oh, great, we have you. Perfect. Okay.
Hi, I'm Cindy. I'm a founder working in mental health space, trying to solve mental health crisis. My question is that, so it seems like, as a founder, I only have limited time to go, fundraise. because I need to focus on building the product. So does it mean that versus, compared to the traditional financial VC, impact investor have a different, in addition to the financial return, there are different sets of like criteria we have to meet, and that takes extra time. And if we're, taking extra time to fill out those like criteria, so is it like better for us if we can just get traditional VCs, then we should just go ahead and do it? And or like what are some other advantages to go after impact investors? Just try to help me understand. Thank you.
Well, I think there's like if you're raising equity and you're going to a VC firm and they're aligned in terms of like they want to fund in the healthcare space or mental health. I mean, there's also just like a lot of advantages to, there's going to be a specific type of person who is running that fund who will understand the challenges that you're trying to solve and be able to best support you in that, versus maybe a more traditional VC investor who's just like healthcare focused. They're going to be like profit driven and just like only worry about the profit without necessarily caring and paying attention to the impact that you're actually trying to create. So there could be a lot of more alignment in terms of investor thinking and support that you might get from a more impact aligned investor in that space. So that's one thing, but.
To be really specific on the support side, every venture firm, at least over the last 15 years, has worked hard to differentiate everything that is not capital, because that's become a commodity. So like we have a huge, massive network of folks who come from the UW ecosystem. We're very well connected with each of the different like departments within UW. And so what you're going to get from me is very different than you're going to get from, some random other pre-seed fund. So if you apply that in your same, mentality here, maybe you find an impact investor that has a consortium of 3,000 mental health care clinics. And so it's okay, the trade-off of what you're making here is it's a little bit more to get the money, but again, it's not just about the money because there's this other thing with it. And so that's true of any investor you talk to. And there's a number of investors who are still, hey, here's a check and come back to me in 10 years with 10 times as much money. But I would say most of the institutionalized investors these days are talking about trying to, and they're demonstrating what they do to help you beyond just the capital. And it's the same thing for impact, I think.
Yeah, I was wondering if there are different buckets of investors, say like a grant-like one where a return is not required, or ones that are just purely like principal preservation. And then, you mentioned that a lot between the balance with financial returns versus other markers, right? Like greenhouse gas reduction and all of that. So like help us understand like the different kinds of buckets, if there is, like buckets of money and what kind of investors they are. And again, I'm also kind of piggybacking off a question, like between like a traditional investing versus impact investing. My perception of it was more, it's less return focused and maybe longer time frame. So maybe help us understand that a little bit more. Thank you.
Yeah, so there, maybe just to like get a lay of the land. So Bridgespan has a really great graphic that kind of that you can easily find online that shares like the whole spectrum of impact capital that I was speaking to before, where anywhere from an ESG fund to or do no harm screen on funds to deeply private investments. Also, Adesina Social Capital has a really beautiful kind of spectrum as well that kind of also goes a level deeper and talks about like the trade-offs there. I would say in terms of investors in the space, you will find that more on the grant side, you're going to find mostly like philanthropic organizations, high net worth individuals, family offices, like Allison had mentioned. And then as you move kind of away from the grant space, maybe more to preservation of capital, you'll see that's more like program related investments within a foundation's endowment. But I think like, yes, and foundations might be targeting 5% return out of their program related investment portfolio. So that's not really capital preservation. But, there's like We could spend hours. I could spend hours. But like as you go away from that space, you'll start to see like more traditional investors in the kind of more market focused area. The only other thing that I would just name is like I think it's I don't think the impact investing world feels that they need to give up financial returns for impact. Again, I don't ascribe to that. I feel like I'm also just like, in some instances, yes, but in some instances, no. So like, I think there's a wide range. And so I wouldn't just limit it to thinking that all impact investing would be focused on a concessionary or non-market rate return.
I would maybe reframe the definition here. I've never seen a single capital allocator give out money without some expectation of return. The question is this a financial return? Is this a health return? Is this a climate return? And so if you define that for you, that is the bucket you are going after. And it could literally be anything. And so we are all looking for a return, but it is just, what does that mean to me as an investor is what you've got to try to suss out and then see if you align with that. So yeah, it's across the spectrum. I've seen it for literally everything, I think, at this point.
Well, and the patience side of that as well, right? The return. As an equity investor, regardless of if you're doing that with an impact focus or not, you're a long-term investor. If you have any early equity investors coming in looking for a quick flip, that's not a good thing. But I do think there's in terms of people that are really true and genuine in terms of having the desire for material or genuine impact, they will have more long-term thinking, right?
So as investors, I'm curious what the conversations with your LPs look like when you are, pitching this impact-driven fund to them. Like, how often are they driven by the mission that you're talking about versus returns or so forth?
I'm going to pass this because we are not an impact-driven fund. So, yeah.
Oh boy. Okay. Okay, just to maybe set expectations. The fund that I am raising is a restorative fund. So it is not producing any type of financial return for any LPs that come in. I will say that doesn't mean there's no return. There is as Ken mentioned, there is a big social return for a lot of our products and investments. But because of that, it makes fundraising quite hard. I'm fundraising from philanthropy and high net worth individuals primarily, and there has to be mission alignment. The fund that I'm raising is focused on racial equity. So like there has to be alignment there. And there has to be mission alignment. And that's hard when you have foundations and high net worth individuals who might change their focus areas, who might not be interested in that, who might be kind of interested but scared at this moment. So like it is, for me, like if I'm approaching an investor and they say, okay, great, we will have to give you a PRI and it's a 3%, a 10-year note for 3%, I'm like, I can't accept that. So there's no real conversation there. I'm privileged to be able to do that, but it's also, I know that that's not the case for every fund, every investee. And so I would name like understanding what your boundaries are and understanding what your mission alignment is. And I think Ken spoke to this earlier, like make sure there's alignment. Because if there's not alignment, then like there's not any point to having the conversation. Whether it's mission alignment or financial alignment, like you have to know where your own boundaries are for your own organization.
And I would add, relative to mix of investors and varying degrees of interests, whether financially or impact related. I'm currently working with a early stage fund right now, and they have different LPs coming in with different expectations in a couple different areas that are actually critical to their ability to actually execute on their strategy. So in this case, it has to do with a geographic allocation in the fund, and certain investors wanting more capital to go in one area than another because that's part of their definition of impact. And so it's a negotiation because if that decision only reflects that piece, then the strategy for the overall fund is jeopardized, and you're going to scare off other investors. And so I think there's not one simple answer. It's looking at it holistically with what the fund's trying to accomplish, and are the investors able to get on board and say, okay, we understand that there's going to be hard decisions to make here or sacrifices here, but ultimately, we understand the strategy, we believe in the strategy, and we're comfortable getting on board.
Are there any more questions? Oh, there we go.
Just to follow up, one of you mentioned timeline. So there's what is the return people are getting? And I'm wondering if you can comment more on the timeline. You mentioned, is it the really quick turnaround in a year? Are we talking about 10, 100 years? What's the appetite? What's the appetite along the whole spectrum and availability?
I mean, I think there's appetite along that whole spectrum. Like, there are people who come out and say, we're doing 100-year things only. I think the size of your potential investor pool shrinks the longer you go. But most folks that I work with, so most traditional venture funds everything operates around a 10-year horizon, right? We get a couple years longer, but 10 years is about what I see. A number of folks that I know who do climate investing or deep tech investing with an impact focus, so think, ag tech or material sciences that could lean to cleaner energy or cleaner products. A number of them have much longer timelines. Like, their fund is structured around 15 years. Very similar with life sciences. It's very hard to create a cure for cancer in 6 or 7 years like you could do with a software company, right? So I think there's appetite across all of it, but these are great questions when you sit down and you give a 45-minute pitch, that last 15 minutes should be your short list of you qualifying them to see if they fit with you.
I have a similar question, but along the organization size spectrum, is there like a minimum sort of size where you shouldn't even bother kind of looking, or is there appetite from just one person with an idea all the way up to a huge organization looking to grow?
Yeah, I think there's appetite across the entire spectrum. I think it just depends. I think it really does depend on, if you're starting up, and you need that capital to start up and you don't have your own funds to do so, it really does require you to spend a lot of your first year pitching and trying to get money to even get off the ground. So yeah, you can start with an idea. I think that's totally fine. That's totally fair. There are people who are willing to come in at that stage. I think that there's there are trade-offs that you make, right? If you are two people and one person can work on the product and you can go out fundraising, great. But I think there's no limit.
I think it might be more difficult depending on where you're at, right? When you're one person with an idea, right? Obviously, there's only so many investors out there that are going to have that appetite. And so I think that as you're thinking about when to raise or how to raise or who to raise from, I think it's just being realistic with yourself about whether or not investors will even be able to write the check. So as an example, with one of my previous funds. We wouldn't invest in a fund manager if it was a single GP. That was just something that we decided we couldn't get comfortable with the risk there, and so that was something we were upfront with funds when they were pitching us about. But we wouldn't have been a fit for the single GP fund. So you're going to have a spectrum there in terms of how people view it.
Yeah, so the way that I think about this, and this is true for any startup, so you set your metric at the top of whatever the impact you're going to have is. So for maybe a traditional software startup, it's all about revenue and growth. There's 3 types of risk for every new startup company, in my opinion. The first one is technical. Are you breaking the laws of physics or biology with what you're trying to do? And we have to assess that. The second is market. And what that means is if I build it, they're already there waiting for it. Not if I build it, they will come. That's a pretty quick way for me to pass. And then the third is execution risk. And the execution risk is actually speaking to the team. And can they marshal the resources, whether it's people, capital, et cetera, to minimize those other 2 risks? Okay. It's crazy. We're in a time, especially on the software side, where I firmly believe we're going to see a $1 billion company built with 1 or 2 people in it. Because in software, there's 0 technical risk with the exception of one thing, which is general intelligence. On life sciences or deep tech, it's fully the opposite. It's all technical risk and no market risk. So software, it's all market risk because you're trying to prove that someone really wants this thing. But for a lot of impact investing, which sometimes has a like deep tech or life sciences focus, what do you need? Are you sufficient as a single founder to get through that technical risk or not? Then probably a 1-person company is not sufficient.
Hi, back here. I might have or might have not used ChatGPT to form this question. How do you see crowdfunding and crowdsourcing fitting into the impact investing landscape? Different role in scaling and sustaining impact-driven ventures.
So I've got an opinion on this one. Again, it's about alignment to what you're trying to do. Okay, so if by doing something through a crowdfunding or crowdsource gets you actual validation, because some people think it's getting them validation, but it doesn't. If it gets you the network of people you need to go do what you need and want to do, then it can be valuable. The trade-offs are a lot of investors will not invest in a company after they've done a crowdsource equity round because the law is still a little bit unsettled. We're not sure what we're going to do with this and what their rights are versus ours, additional risks, all those things. So again, it just creates a different trade-off for you. You could also, good, from what I've seen, good crowdfunding campaigns usually take like 3 to 4 months of a team's time to like do all the crazy videos and the marketing materials. And so could you spend that 3 or 4 months on something else? So I think it all still comes down to what is the goal, what's the purpose, and what am I trading off to go get that thing?
I mean, I think just to add to that, I think it's also like you have to think about what's available to you and for your organization, what's available. And maybe connections to those investors is not what's available right now. And maybe crowdfunding is the right way for you to generate that friends and family round to support your organization to get to the next stage. So I would also think about, I think that these types of resources are great in terms of also making it just more accessible for individuals who have really great ideas to actually be able to say, hey, community around me or this online community, do you feel like this is a great idea too? And come invest in my vision. So I think there's like such, in terms of democratization of capital, I think it's like beautiful and it's wonderful. And with all things, like investors will get over themselves over a certain amount of time. So like they'll figure it out.
Well, thank you for all the questions, everyone. We are sticking around for lunch, so we'll have an opportunity to network with you. So lightning round. We'll start with Ken and move back this way. What is one thing you wish you had known when you were in their shoes?
I think it's really spending the time to articulate your story. I think founders underappreciate that most of your job in the early years is selling your vision. And that's selling it to people you want to work with you, selling it to investors, selling it to customers, right? And the more work that you can do to refine that in these early days and get feedback on it and just be honest with yourself if that's landing or it's not landing, or, you know, I'm maybe a little bit delusional and I think that it's going great, and when I'm really listening to the feedback, it's not. I think grounding in that sets the foundation for, you know, fast growth afterwards.
I think really just having an understanding of the tools available in the toolkit that goes beyond just knowing that there's the option for a recoverable grant or a revenue-based finance instrument. Understanding the repercussions of those things, how they all tie together, how it fits into your long-term vision, if you want to go raise traditional equity, really spend the time to understand what's driving the decision-making between the investors or with the investors that are using a particular instrument, and figure out what that whole landscape looks like when it's put together cohesively into one unit, which is your business.
I would just say build your community. You're going to need a lawyer. You're going to need a person who knows finance. You're going to need you're going to need these people, and they're out here all around you. So build your community, because these are the people who you're going to lean on when you're just starting up and you don't have that experience.
Great, thanks everyone. Thank you, University of Washington CoMotion Labs, and I will turn it back over to you.
Thank you. Thank you all for joining us today, and a big thank you to Ken, Jack, Sandhya, and Allison. Next Friday at noon, SAS Capital Managing Director Rob Belcher will talk about venture debt financing. Sign up today and we'll see you next week. Now join us for pasta in the lobby. Happy Valentine's Day.